Tax credits are a dollar for dollar reduction in the tax that you owe. And there are some obvious examples of these kinds of credits that exist today, or at least as long as Congress hasn't finalized the new bill, where, for example, you buy an electric vehicle and you get a tax credit. If that credit is $7,500, that means that if your tax bill before was $10,000, well, now you subtract $7,500 and now it's $2,500. That's a dollar for dollar credit. And a lot of the strategies we'll be talking about today involve credits. The second concept is deductions. Tal, do you maybe want to describe the concept of a deduction just at a high level?
Yeah, of course. So a deduction, as opposed to tax credits, is reducing from, like, you can think about tax credits, you're getting what you're deducting, you're reducing from the bottom line. Deductions, you're reducing it from the top line. So if your taxable income was $100 and you need to pay 20% on the $100, you will pay $20 in taxes. If you get $20 deduction, instead of paying taxes on $100, you will pay taxes on $80. And let's assume that the tax rate stays the same, 20%. So 20% of $80, it's 16. So you will pay $16 instead of $20 in taxes for $20 in deductions.
That's right. And so in general, $1 of credit is more valuable than $1 of deduction. Of course, you're reducing your tax instead of reducing your income, but they're both useful and they're both a big part of the kinds of strategies that we're going to be talking about. Depreciation, very quickly, is just one form of a deduction that applies to a lot of the different strategies, whether it's real estate, solar energy, oil and gas. We'll talk about a lot of those things today. And the idea is that when you buy a physical asset, the IRS assumes that it loses value over time. That may not be true in practice, right? You buy a house, it typically gains value, but the physical thing, there's wear and tear, and the IRS essentially lets you deduct the lost value of the physical thing over time. And that's an important principle that we'll have to talk about today. So now we're in it. We're going to, at a very high level here, I think we're going to kind of speed through to a case study, which is really where the rubber hits the road on this sort of thing. We want to talk in detail about what sort of planning we can help you with. But at a high level, we've divided the strategies that we're going to be talking about today into two categories: strategies that can help you with capital gains taxes and strategies that can help you with ordinary income taxes. And so I'll talk about capital gains in part because it's a lot of what Valor does. The main strategies that we have on the menu for capital gain planning are listed here. I'm not going to go too deep on them. We've done other presentations on each of these. You can, of course, read about them. If there are questions, I should have said at the outset, feel free to chime in over the course of the conversation. We'll answer things as we go, and we'll also hopefully leave some time. But the concept here is that when you're earning a capital gain, which is the amount of appreciation or the extra income that you get from an asset that has grown in value over time, there are a few different things that you can do to reduce your taxes. The first is you can defer the taxes. So, for example, if you set up a charitable remainder trust or an exchange fund, both of those vehicles allow you to basically put the assets into a thing that's shielding them from tax for a certain amount of time. And in general, putting off your taxes is valuable. If you're going to pay $100 of taxes, you'd rather pay it in 10 years than today. So that's the first, I think, important thing that we can do. The second thing we can do, or the next group of things we can do, is we can reduce your taxable income via the kind of deduction logic that Tal laid out. So when you have a charitable remainder trust or an opportunity zone, you can adjust the amount of income that you're being taxed on, sometimes by adjusting the cost basis, which means how much you paid for it. You're going to pay tax on the growth in the asset. And so if your basis goes up, you pay less. I'm not going to go too deep into this, but the idea is that there are a number of principles here that you can use to reduce the capital gains tax that you pay. Deferring your income, adjusting your cost basis, getting deductions off the top. And in all cases, really importantly, there are some major features of these strategies that we're trying to plan for.